Some interesting news around NIO's secondary listing in Hong Kong, which is imminent. And well, first let's talk about the details of that, but then also talk a bit about could this be a model for Chinese equities in general and actually remove some of the negative sentiment and some of the shambles that are going on in the US exchanges? Well, let's find out. First of all, this is the news article by Sina Finance, and this one is auto-translated and talks about a Hong Kong Stock Exchange listing by NIO. And first of all, we knew that they're going to do their listing via introduction. So that means that they won't do a new IPO in Hong Kong and issue new shares. So this is why basically it's not dilutive to shareholders as well. Instead, what they are doing is they're taking some of the shares from the US exchanges and transferring them to Hong Kong. And well, in the prospectus, we saw that Tencent and NIO doing this together in order to provide some instant liquidity for the market makers in Hong Kong once the shares start trading. And that should be around 40 million shares. But here's the news now today that NIO said that a total of more than 778 million Class A shares will actually be removed from the register in the Cayman Islands and be included in the Hong Kong share register before the date of listing. And this will have to result that approximately almost 60% of the underlying shares of the ADS will be removed and come to Hong Kong. So meaning actually that more of half of NIO shares in the future will not be with the New York Stock Exchange, but actually in Hong Kong, available for those who prefer to trade in Hong Kong and the Asian investors community. So this may bring some very interesting implications for NIO stock in general. So some may even ask whether or not this could trigger a short squeeze or at least kind of diminish the effects of the short selling mechanisms that are going on very obviously in the US. And I've been pointing out some stuff happening in the past in some previous videos about fails to deliver, indicating naked short selling and some false rumors out there in the media, possibly helping to drive down the stock price. And well, that's not uncommon in the US, we know that. And in Hong Kong, well, there's far less going on in this regard, while there might still be the possibility of borrowing shares for short selling, but still it's much less common, and I think the Asian investors are not playing too much in this regard. And also the thing is that naked short selling is not possible in Hong Kong at all. And while in the US it is possible, and although not quite legal, it is still happening. And as I mentioned before, there are indications that this is even actually going on with NIO. Now, with this big chunk of shares being moved from the US to Hong Kong, this will actually decrease the float and the shares available to borrow in the US, and thereby making the fees higher for borrowing for short selling, and maybe even bringing those into trouble that have actually sold naked. Right now, we cannot say for sure that this is exactly to happen, that the smaller float of shares available in the US will actually have those effects on those who are short selling NIO. We are about to find out, but generally the effects on NIO and possibly other Chinese companies that are going to do that is certainly bringing a larger chunk of their equity back home to the markets where the investors really are understanding it and possibly not so much into betting against the stock. And thereby could have positive implications overall. And this, of course, needs to be reflected in the share price then, no matter if it's traded in New York or in Hong Kong. But this could certainly become a model for more Chinese companies to kind of do the same thing. And maybe this could have some implications on the sentiment towards Chinese equities in general, where if you look at this graph right now, what you can see here is the performance of KWEB, so the ETF that lists Chinese internet companies, with the sharp decline recently. And down here you see the sentiment along the timeline from excessive optimism, that's everything above this red line here, and excessive pessimism, that's all the time we've been below this green line here. and currently we are really at the very low, as much low as we have been during the Corona crisis, during this very sharp sell-off, as well as in 2015. And usually those low points in sentiment also marked kind of a reversal in equities. So hopefully this could be an indicator that right now the sentiment towards Chinese stocks is too pessimistic and could actually reverse. And so this negative sentiment obviously helped for those who have been betting against Chinese equities in general, or NIO stock in particular, because NIO was also dragged down by this very negative sentiment against China. And maybe that was even facilitated by some of those hedge funds that have been disseminating negative articles about China in general, about the tech crackdowns, and this has contributed to this overly pessimistic sentiment in Chinese stocks, and well, thereby they have been selling stocks and equities, or also buying puts and making their bets. And so I do think that this change with this listing by introduction that NIO is now doing might be one of the tools available for Chinese companies to work around something like that in the future. Then of course there will need to be more positive news in the future as well again, so that also needs to be happening to lift the sentiment, and these would then remove some overhang about NIO stock and Chinese equities in general. But of course on top of that, what really needs to happen on the fundamental basis is also NIO delivering and showing these results to the markets, and all of this in combination could really help to find a bottom and lift the stock again. I'm optimistic about that. Let's see. Anyways, thank you guys for watching, and see you in the next one.